We often hear of these high-speed trading algorithms, but what is it that they actually do? Hey guys, Roman here, quantitative researcher and trader, founder of Quant Guild, and today I want to explain this idea of algorithmic market making. This is exactly how large financial institutions use probability and statistics to make money in the real world. This is often left outside of the classroom when we study these topics in an academic setting. We're going to take a look at a dice market, and if we can make a market there, we can extend that idea to any source of randomness or uncertainty. And that's exactly why we can see pretty much everything is tradable these days, not just stocks or options, but even your favorite sports team winning or the weather next week. We're going to discuss the math that makes all of these markets. Depending on the events you're looking to trade, your location may restrict access to that market. Unlike my Jupyter Notebooks, which everyone has access to regardless of their location. I'll leave a link to this Jupyter Notebook in the description below. I'll also post it to the Quant Guild library on GitHub, where you can find all of my Jupyter Notebooks and associated YouTube videos, along with all of the source code for my quant builds. At the top of this Jupyter Notebook, you'll notice some related Quant Guild videos applying probability and statistics to finance and trading, this idea of time series analysis, retail versus institutional trading, trading versus investing, this idea of accumulating positive expected value over time, the difference between quant and discretionary trading, and of course, busting 3 trading myths that these trading gurus love to propagate. If you're unfamiliar with any of these ideas, I highly recommend you check these videos out first before tackling one like this. Moreover, these videos certainly take a lot of effort to create, so if you'd like to help support the channel so I can continue to create videos just like this one, please like, comment, subscribe, share. It helps me out tremendously. It is always greatly appreciated, and if you'd like to master your quantitative skills, check out quantguild.com. Maybe you come from a background in business, economics, computer science, and aren't too sure where to get started on your quant journey. Maybe you're an aspiring quant or a working professional looking to sharpen those technical skills. In any case, Quant Guild is for you. We have over 90 quant lessons in math, probability, finance, an adaptive practice engine that scales with your skill level so you can progress to more and more difficult topics with gamified rank-based progress, interview questions with fully worked solutions, trading games, courses from A to Z in math, coding, probability statistics, and more on the way. And all that's included with Quant Guild membership. And you can get started right now for free. So if you'd like to help support the channel and master your quantitative skills, check out quantguild.com. Without further ado, let's get started by discussing this idea of making a market for a dice. What is a market maker anyway? Well, when you go on Robinhood and you buy a stock or an options contract, you need somebody to take the other side of that trade. And that somebody is a market maker. They are serving a business function as a liquidity provider. They quote prices, mainly the bid and the ask or offer. The bid is the price that you can sell to them at, and the ask or offer is the price that you can buy from them at. And they are taking the other side of whatever trade you place. Let's take a look at an example in the context of this dice market. So for example, a trader wants to go long 1,000 shares at $3 per share, where a share here is just going to be a dice roll. Who's going to take the other side of that trade? Well, that's going to be our market maker. So they are going long 1,000 shares. That means our market maker is short 1,000 shares. A dice is going to be rolled and the outcome of 6 is realized. So who makes money in this case? Well, our trader is long and they were long at $3. The realization is 6. So they make the difference, and that's going to be $3 per share for their 1,000 shares, or $3,000. Now, the question is, how do we determine the price that that trader can transact at within this market? That is quite literally the job of a market maker. If they do this effectively, they quote effective prices, then our market maker's wealth path over time should look something like this. They don't get to pick the sample path that they walk, but the overall expected value or the trajectory of their wealth path is positive. And if they're quoting prices in an ineffective way, then the overall trajectory of their wealth path is going to look something like this. So how do we dictate the prices that we're willing to quote traders in this dice market? Well, clearly there's going to be a positive difference between the ask and the bid. Otherwise, our traders could make a risk-free profit, always buying low and selling high just directly back to us as the market maker. So if there is a positive spread there, a reasonable question to ask is, what is the midpoint? Maybe that can help us dictate how we quote our prices. So this is going to be known as the mid price. In the context of our dice market, I'm going to ask a simple question. What is our best guess for the outcome of our dice roll? Let's make that our mid price. I'm going to call it theta. And what I'm going to do is look at this error function, the mean squared error, and that's going to tell me how effective my guess theta is. And what this then turns into is a minimization problem. I want to pick the best theta possible to produce the lowest error. And if I visualize this for you, you can see we get something that looks like a nice quadratic here. And the lowest point on this function is going to correspond with the theta input that produces the lowest error. In other words, functionally, it is our best guess for the value theta, our mid price, the outcome of a dice roll. It turns out that this value, our best guess for the outcome of a dice roll, is 3.5, but a dice can't land on 3.5. Where did this value come from? If we take the average of our dice roll, that is all of the possible outcomes, we actually get that exact same value, 3.5. And this isn't a coincidence. If I look to solve this formal minimization problem and I apply the necessary calculus, take the derivative, set it equal to 0, treat the expectation as the constant that it is, in the context of this problem, I find that our optimal choice of theta, that mid price that produces the smallest error, as we just saw here, is equivalent to the expectation of our dice roll. And in this case, we said the expectation, the mean or the average is what? 3.5. So that is the formal math behind what is going on. Instead of applying the calculus directly, you can take a look at this animation, which is numerical minimization. It's applying the exact same idea to go about finding this idea of the lowest error. Effectively, we are just riding the roller coaster down until we find the best possible mid price that produces the lowest error. How do we know that this is the correct mid price? Well, the outcome of a dice roll is fully specified by its probability mass function. In other words, the probability of rolling a 1, 2, 3, 4, 5, or 6 is fixed. It will never change throughout the life of our dice market. And what that means is all of our probabilities, statistics, and distributions are going to converge. And that's exactly what you're observing here in this animation. As I continue to roll a fair dice, I'm going to take the cumulative mean and it is going to converge with probabilistic certainty to that theoretical mean of 3.5, which we computed above. And that is our mid price. Our goal now as a market maker is to quote a bid and an ask or offer around this mid price. So how do we do this in a way that we are certain statistically that we are going to accumulate wealth over a series of trades? Well, I'm going to apply the law of total expectation. I'm going to assume an equal volume on either side of the spread, and I can apply the expectation directly to the difference between the outcome of a dice roll and the price that we end up transacting at. When selling at the ask, the profit is going to be the difference between the ask and the realization, And when buying at the bid, the profit is going to be the difference between the realization and the price that we paid at the bid. And it turns out that the expected profit per trade is going to be the ask minus the bid divided by 2. In other words, it will be the spread over 2. So what does this mean? Well, if we can increase the spread, then we're going to have the highest possible expected value per trade. So let's just make the spread incredibly wide, and we'll accumulate a tremendous amount of wealth. And it's going to look exactly like the process that we had observed earlier. Our wealth path would then look something like this. We'll accumulate a whole bunch of wealth. Well, what happens if we make the spread tremendously wide? Let's take a look at this simulation. That doesn't look anything like the chart from earlier. We only had 2 trades in this market with our really wide spread. But theoretically, if we increase the spread, we should be making more money. What happened here in this market? Well, remember, we are a liquidity provider. If the spread is too large around some sort of fair price, nobody is going to transact with us. So in reality, if we're trying to look at this as some sort of optimization problem to maximize our expected profit per trade, in reality, it's not a linear problem. We can't just increase the spread. At some point, nobody is going to transact with us, and that's exactly what we saw in the animation above. In reality, it's going to look something like this, where there is a sweet spot between the spread being too wide and being too tight. In illiquid markets, the spread will be wider. In highly liquid markets, the spread will be extremely tight. And a lot of markets are extremely liquid now due to the algorithmic capacity of market making, applying all of the ideas that we've discussed so far. If that is too much, then we can just take a look at this animation and see what happens when spreads get tighter. We're going to have more trades. As we can see, we have a significant number of more trades relative to this example where we quoted a spread that was way too wide within our dice market. So when it comes to making a market effectively, how are we accumulating wealth as the market maker? Well, effectively, all we're doing is buying low and selling high every single time relative to that mid price, which is the theoretical fair price, the mid price. And if we do this, we can see what happens. We're going to be accumulating that difference. It's going to be the spread over 2. That is our expected P&L if we have an equal volume on either side of the spread at any given time. And this is our market maker P&L for a series of trades. Keep in mind, you are not without risk as a market maker. You are just subject to different risks. So we understand now the idea of making a market for a dice. We find this mid price, quote a spread around it that is of a reasonable size, and we can then accumulate this wealth over a series of trades. But how does this extend to something like making a market for an options contract? Well, things are a little bit different here. In the dice market, the realization occurred instantaneously. We transacted and then rolled a dice, and then we settled up. But when it comes to making a market for an options contract, that contract has a maturity at some point in the future. We're not just realizing some sort of payoff, as we see here on the left. This payoff is realized at time capital T in the future. And that's exactly what we see on this chart here on the right. We can see at time capital T, that's when we settle up. And we don't know which sample path we're going to end up walking. So the question now is, how do we come up with the mid price to quote a spread around to make a market for these options contracts? It turns out nothing changes from our dice market example. If we apply the fundamental theorem of asset pricing, it says that the fair price of our derivatives contract today is just going to be a discounted risk neutral expectation. It's an average, just like the average of our dice roll. That is going to be our mid price. But Now we have to figure out how to come up with this average value. It turns out we need to pick a model. We can pick a geometric Brownian motion, a Heston, a rough Bergomi. We have a lot of different models to choose from, and this becomes a pricing problem. Now, there are a lot of different moving pieces here. We're dealing with risk-neutral dynamics. We have the replication argument from Black-Scholes. That is a complete market relative to an incomplete market with imperfect hedging, but we're not going down that rabbit hole here. All we're saying is relative to our dice market example, we're dealing with an expectation, and we're going to pick a model to come up with that expected value. We're going to select a model that makes sense for the market that we are making. So in the context of equity options, we may choose a Heston stochastic volatility model, but now that we've selected a model, we need to pick parameters, right? There's a lot going on here. What do I choose for my value of theta or my initial variance, so on and so forth? Well, these dynamics are given to us by the market. We have as many choices for a risk-neutral measure as we would like. So which do we choose? Well, we're just going to calibrate the model directly to the market, and that is going to be the risk-neutral measure that we choose. So effectively, this turns into a calibration problem. You can see this flat surface here is the initial selection of our model parameters. In this case, it'll be a Heston model, and as I calibrate the model parameters to the market volatility surface, I am going to have maybe some error, some play between the calibrated surface and the market surface, but I will then derive the risk-neutral dynamics. Now that we have selected a model and calibrated it to this set of liquid instruments, this implied volatility surface here, we can simulate our mid price. That is going to be the risk-neutral discounted expectation of the payoff of our contingent claim by the fundamental theorem of asset pricing. And if that is a little too complicated, we can just look at this animation here. By the law of large numbers, I can continue to simulate paths for the model that we selected after we've calibrated it. And what you're going to observe here is if I continue to observe the payoff at that time capital T in the future, discount it back to the present, take the average, I'm going to get similar convergence to what we saw in the dice market example with the mean of the dice. And that is exactly what we're seeing here, given the dynamics of the model. They are fixed for that parameter set, and we are certain that the price will then converge to the theoretical price under those parameters by the law of large numbers. Depending on the market that we're making, if it's highly illiquid or it's a custom tailored product for a client, we may need to make adjustments to this theoretical price that we found after calibration and selecting a model that are beyond just the profit that we would like from the bid and the ask spread itself. And that's to say, we also need to consider adjustments for counterparty risk, liquidity, and all of this relative to our original profit margin and the discounted risk neutral expected price given by this simulation. And if we do this in an effective way, you can see theoretically we will accumulate this spread over a series of trades in the form of positive trajectory in our wealth path, trading P&L. There are several catches here, however. First is, what if our model is not effectively capturing the dynamics that we could observe in a forward-looking sense? In other words, what if it's not the correct mid-price? We're guaranteed theoretical convergence only to that model's price. It doesn't mean that the model is correct. For example, after calibration, what if we realize something that looks like this instead of the previous example? We're actually going to be accumulating losses. And this is because we've selected an ineffective model. So that's one catch. What about the other that I mentioned at the start of this section, making a market for an options contract? That is, in our dice market, the realization occurred instantly. But here, the payoff isn't realized until time capital T in the future. Well, this gets into the idea of hedging. When we make a market, we are not just going to sit around and wait for the payoff. The portfolio replication argument given by Black-Scholes says theoretically if we had perfect hedging, then the cost of that initial portfolio should be equivalent to then the price of the financial derivative. And if you recall, we're quoting a spread around that fair price. So we're constantly going to be theoretically buying low and selling high. And our hedges then are going to eat away at the profit from our spread. And that's exactly what I'm showing here. The reality of making a market, you're going to have imperfect hedging, and that's going to eat away at your profits. The more effectively that you can hedge, the better you can then capture that spread as a liquidity provider. And there's a lot in the literature that suggests there are different ways to deploy reinforcement learning to do this. Hans Buehler has some incredible work, even with Blanca Hrvath, on this topic that I highly encourage you check out if the subject interests you. Too long didn't watch. Here's your executive summary. In the face of structured randomness, you can think of something like a dice roll market or uncertainty, the markets themselves. We can apply probability and statistics to make money systematically. Now, we can never predict the outcome of any one trade or any one random variable. Our goal is to make money on average. When distributions are fixed, the expected value, the mean, the average, gives us a best guess in a realization in the mean squared error out of sample sense. Should we transact then around that mid price, quote a bid, ask offer, we will accumulate a positive drift, even with an entirely random outcome. Now, in reality, distributions change. Probabilities, statistics, distributions do not converge. However, the same principles hold, but we need to select a model, calibrate it to the market, and then simulate prices. That is our fair price. Fundamental theorem of asset pricing suggests that. And we can then quote a price around that to accumulate the same positive drift. Now, unlike the dice market where realizations occur instantly, we will have to hedge throughout the life of our position to collect that theoretical spread. Theoretically, continuous hedging with no transaction costs result in the simulated price of our contract, so our position would be net zero. But remember, we're transacting at the bid and the ask. We're constantly buying low and selling high statistically, giving us an edge to accumulate. So in reality, due to market frictions, transaction costs, so on and so forth, the efficacy of our hedge will dictate how effectively we collect that theoretical profit from the spread. Some future topics, technical videos, and other discussions to look forward to. I'd like to develop this idea of a quant roadmap, how I would go about studying if I had to start all over again. I think there's some interest in this topic, so let me know in the comments below if that is the case. I'd also like to cover some projects that I consider made me a quant, how I received my first quant offer. I'd also like to get into more advanced Markov chains, something you might see in a stochastic processes class. Definitely more niche, non-Markovian models, this idea of reinforcement learning for delta hedging, approximating pricing functionals, and rough path theory and applications of path signatures. I'd also like to get back to our quant builds. I know it's been quite some time, but I've been toying with a lot of different ideas for builds from A to Z. These are multi-hour videos. They certainly take a tremendous effort to create. So if you have any ideas or would like to see any of these built from scratch, again, let me know in the comments below. It certainly helps me figure out what videos to create next. And that's going to do it for this video explaining algorithmic market making. I hope you enjoyed. I hope you learned something. This video certainly took a tremendous effort to put together. So if you enjoyed it and you want to see more like it in the future, please like, comment, subscribe, share. Again, it helps me out tremendously. I'll leave a link in the description below. If you'd like to join our Discord to connect with me and other quants in the Quant Guild community, if you'd like to master your quantitative skills, check out quantguild.com. Other than that, thank you so much for watching, and I will see you in the next video.